Happy lunch hour, gang. Okay, Tuesday afternoon and plodding along. Don't you wish you had a crystal ball? What if I told you you probably do? You're just not reading it. Okay. It's kind of funny. I watch this. And again, we're going to talk about finances because that just happens to be the big thing. You know, economics, the dollar getting weaker, inflation, grocery costs, et cetera, right? You know, oh my God, how am I going to make ends meet next week, next month, next year, wherever, right? You know, what do I do? And it's a question that's on everybody's mind, no question. But the funny part I look at is nobody reads the crystal ball that's right in front of them and goes, you know what? Maybe this time I'll do something different. I'm going to do the same thing I've always done. And it didn't work. Okay. How many of you have ever thought this? Damn, you know, I really wish I would have bought this after 9/11. Or I really wish I would have bought this during the 2008 market crash. I mean, I'll give you this. If you go look at, and I know this one for an example, go look at Citigroup, Citibank, the stock, okay? Around 2008, 2009, it got down to 60 cents a share. It's now in the $60 a share area, okay? Yeah, be a nice return, wouldn't it? We have all these indicators out there, and nobody ever pays attention to them. What's all in the news right now? Oh, gold is at 3,500. We crossed that this morning. And everybody out there is screaming, you need to buy gold. You need to buy gold. No, I'm not buying gold. I buy silver down here because silver's still low. I talked about that the other day. I'm not buying gold here. Gold's at a top. Again, it goes back to the story. If you walk into a store and they go, the teller says, that's going on sale tomorrow. Now I'll buy it today. I want to pay full price. I don't want to get 30% off. You ever done that? Yeah, I won't pay the sale price. I'm going to wait till it goes back up. That's what people do with the stock market. It's what people do with investing. I look at this morning's news. There was an interview with Steve Forbes yesterday. You know who he is, Forbes magazine, okay? One of the premier business magazines out there. And Steve Forbes is saying that we have the potential to go back to the way things were in the 1970s. Now, some of you guys remember it. Some of you guys were adults at that point. I was still a kid. But, yeah, that was when you had 18% mortgages, 20% treasury bonds and stuff like that, okay? Interest rates were astronomically ridiculous. And we had a period of massive inflation. We're at the risk of that right now with all of these tariffs, with the trade war that's going on, with the fact that we don't want all this Chinese-made garbage in our country, but we don't have the capacity to produce it ourselves at this point. Okay? The idea is to get there, but it doesn't happen overnight. So there's going to be a lot of pain before we get the pleasure. And we have to navigate those waters. All right, what are we going to do for the 6 months, 12 months, 18 months, 24 months, whatever it takes to ramp up manufacturing here in the United States? And again, you hear all these people, it'll take 20 years to build a manufacturing plant. And Elon Musk is like, hold my beer. It took us 6 months to build a plant in Texas to build Tesla cars. Okay. But we can do it quickly as long as we get rid of all the regulations and the red tape. The issue comes to this, and I got a kick out of, you guys know who Larry Fink is, right? The guy who owns BlackRock, everybody's favorite. Chances are there's a bunch of you guys that if you're renting an apartment, a house, or whatever it is, there's a good chance that BlackRock is the one that owns it, because remember, he got all those sweetheart deals with Joe Biden to go and buy up all this real estate and then flip it and turn it into rental properties. And so BlackRock is this. So Larry Fink ain't my favorite guy. I think he's a crook. But even he's saying you got to invest wisely. Now, what he's saying, he's trying to cover his own butt, saying, oh, yeah, you should have, money in the stock market, money in the income market, CDs, bonds, whatever it would be. And then he's saying, oh, yeah, you should have 20% of your assets in something like land. Right, because owning land is a great thing. Don't get me wrong. Okay, obviously I own a little bit. It's not a liquid asset. It's not something where you go, oh my God, something happened, big, and you go, I need to come up with $100,000. I'll sell that acreage I have over there. It doesn't work like that. You can sell your gold and silver. You can sell stocks or bonds in minutes. Okay, you can't do that with land. Land's great once you've got everything else taken care of. Once you know your income is taken care of, you're good. People talk about buying diamonds or something like that. Okay, with what's going on in diamonds, the price of diamonds keeps going down. That doesn't make a whole lot of sense to me. Again, why am I going to buy something that is going very good chance of depreciating? When you look at the stock market, okay, ask anybody, what do you think of the stock market? What's the first thought that comes in your mind? You're thinking about Amazon, Facebook, Tesla, the Magnificent Seven stocks. That's not the stock market. That's a part of it, but that's what everybody thinks. Everybody always thinks of, the high flyers, the technology. Technology's everything. What happens when we have this global trade war? And a lot of stuff that is made by these companies or these companies need to operate aren't available. Again, this comes to the problem with China. The tech stocks aren't your savior. They're not the get rich quick. They're the get volatile quick. They're give you stomach pains. They're give people reasons to jump out of windows. Yeah, they'll do that. But you talk to anybody, you read articles anywhere, and they're like, oh yeah, you need to buy NVIDIA, or you need to buy Microsoft, or you need to buy Google. Yeah, because Alphabet, which is the parent company of Google, and the stock keeps going down and down and down and down. Okay. You've got to be contrarian in a market like this. As I said, you look at 2008, Citigroup, boring bank stock, went up from 60 cents to $60. Okay, don't you wish you would have bought some? God knows I do. Okay, didn't. But I remember it because I had Citigroup stock at 50 in the late 90s, and it went to 60 cents. I didn't have it anymore, but I'd follow it because at one point I worked for a subsidiary of Citigroup, Smith Barney, which was the brokerage arm. So you look now and you go, what should I do? And this is what I've mentioned many times, is you start looking at the companies that are out of favor, but the companies that are solid companies. I've mentioned to you before Ford. I've mentioned to you before Altria Group, Philip Morris, basically. Okay, Philip Morris and Altria split, but this is the tobacco arm, Altria. Okay, still a symbol of MO. Why are they good? Ford's got a dividend of 6%. Altria Group's got a dividend over 7%. Looked at other ones, Pfizer. Okay, you know what? Nobody likes Pfizer after what happened with COVID. Pfizer pays 8%. This morning, I got a little bit, bought some Dow Chemical. Not telling you to do it. I'm just being open with what I do. Again, I'm instructing you. I'm not giving you financial advice. But I got Dow Chemical this morning because the dividend yield, as I explained to you what that was last week, is 10%. So stock goes up, stock goes down, stock does whatever, and the money that I put in today, I'm getting 10%. Find me a CD that does that. If Dow Chemical goes from like $29, which is right about where it is now, goes down to 20, okay, loses a third of its value. I'm not selling it, so it's not like I lost any money, but I'm still getting paid 10% on the original amount of money I put in. Unless, of course, they cut dividends, but this is why I'm looking at companies that have decades-long history of buying dividends. My objective, how I'm doing this, how I'm trying to protect my future, Mrs. P's future, is generating an income. Yeah, there may be some growth, but every time I get a little bit of extra money, okay, I'll go out and buy myself 20 shares of it. 35 shares of Dow Chemical cost me $1,000. It's okay. It's not like the days when I was a broker where you had to pay ridiculous 2-3% commissions to get in. Now you go onto your online account, you're not paying any commissions. It's like, what do you care? Okay, go buy 2 shares. You got $60. Okay, start building positions like this. Do it when everybody hates it. When the world is saying, "Oh my God, this is a disaster." Look at the history of the company. Is Dow Chemical going anywhere? No. Okay, still buy your scrubbing bubbles, right? Same idea. You think Philip Morris is going anywhere? No. Okay. You think Ford's going out of business anytime soon? No. Okay. They'll change with the times, whether it's electric cars or electric cigarettes or whatever. You honestly think Pfizer's going out of business? Okay. 60% of the U.S. population takes some sort of prescription medicine. You honestly think Pfizer's going out of business? These aren't the companies that, oh my God, they're great cocktail party deals. It's like, hey, I made, $1,000 in 20 minutes yesterday trading whatever. And I go, yeah, great. And I know I don't have to, like I talked about this morning, stress over what happens because as it goes, I'm going to collect my 6%, my 7%, my 8%, my 10%. And I'm fine. Be strange. Be weird. Be different. Buy what everybody else hates. Sell what everybody else loves. The old adage, buy low, sell high, which is completely contrarian to what social media will tell you, what the regular media will tell you. I'm not telling you to buy anything. I'm just telling you to go be different. Don't follow the crowd. You're not a sheep, right? Why would you do it with your money if you don't do it in every other aspect of your life? Just a thought. Pinball out.